Okay, now let's take this information and then calculate our share of the associate's profit and loss, and then look at the subsequent journals that will be passed. So before we can get to the journals, we first of all have to see what is our share of the associate's profit and loss. Now, from the information, we could get the profit figure for the current year being $180,000. It's an after-tax profit, so therefore all our adjustments will also be made after tax. After taking into consideration tax. So the first adjustments that we make is relating to the profit that sat in the inventory that was on hand. So we deduct the unrealized after-tax profit that sits in the closing inventory. We include the profit that was sitting in the opening inventory, and that is now realized for the year. And that brings us to our post-acquisition equity figure for the current year. Because we've got a 30% share in that, it means that we have a share, our share is valued at $49,800. To that share, we then have to make an annual adjustment for the depreciation that relates to pre-acquisition earnings, so resulting from the revaluation of the depreciable assets on acquisition date, $630. So our share is $49170. Okay, and then the increase in the asset revaluation of $30,000. We have it's a new equity item that was created this year by revaluing land, and our share of that increase in the asset revaluation is 30%, so that's $9,000. Now remember, because Bell's not preparing consolidated financial statements, the required entries relating to his investment in the associate will be passed directly in his account. So we can first of all, from the calculation that we've just done to calculate our share of the associate's profits and loss, draw up the first two journal entries. And because we are equity accounting, you must also remember that all our adjustments are passed against the line item investment in associate. So our investment in associate for the year 2012-2013 is first of all going to increase. So we'll have debit investment in Chime, and it will increase with our share of the profit, which we calculated as 49,170, and the credit is going to an income statement account, share of profit or loss of associates, 49,170, and that will be a separate line item in our statement of profit and loss and other comprehensive income. So that is to account for our share of the associates' profit post-acquisition earnings for the current year. The other one that we also identified there was the increase in the asset revaluation surplus. So once again, our share in that equity account of the associate is going to increase the value of our investment in the associate. So credit our investment in Chime by 9,000 and credit, and this is also on a separate line item then, asset revaluation surplus, 9,000. Okay, so those are the two that we can just draw up from the calculation we've done now to see our share in the profit and loss of the associate. The other two entries relate to the dividends that were paid and declared by the associate. Now, in the question, they told us all dividends may be assumed to be out of the profit for the current year, and dividend revenue is recognized when declared by the directors. So that's the accounting policy. And during the year, Chime Limited paid a dividend of $50,000 and also declared a dividend of $50,000. Now we've got a 30% share in the associate, so our share of the dividend of the $50,000 will then be $15,000, both for the dividend paid and the dividend declared. When the dividend is paid or declared, the investor will record the dividend revenue. But because when we adjusted for or recorded our share of the profit or losses of the associate, we've adjusted it for our total share of all the post-acquisition equity. So therefore, when we receive dividends or recognize dividends that are declared, we have to record it against our investment account. So for the dividend paid, the entry will then be, because we received the income, will be to debit our cash or our bank with the 15,000 and to credit our investment in the associate, 15,000. So that's for the dividend that was paid. For the dividend that was declared, we create a receivable to reflect the fact that we still will receive that amount in the future. Once again, it reduces our investment line item. Okay, so that's with an associate relationship. If it was a subsidiary, all the dividends paid or payable will be recognized as revenue in the profit or loss of the parent company. So as soon as that right to the dividend is established, but then it will be eliminated any balances due between the companies on consolidation. But with an equity accounting, because the fact that this account has already got our share of the profit and loss of the associate before the dividends were declared or paid, we therefore have to reduce this amount or this account balance with any dividends that we've received subsequently. Okay, this is to cover the journal entries when the investor does not prepare consolidated financial statements. The next video will then just look at the entries if consolidated financial statements are prepared and the entries are not passed in the accounts of the investor but on group level.